Waiting 60, 90 or even more days to get paid can be a cash flow nightmare for businesses. Hi, I'm Ian, co-founder of Focus 15, and today I'd like to tell you about factoring and invoice discounting. Invoice discounting is where a finance company forwards an agreed percentage of an invoice that you sent to a customer in advance to boost cash flow. But you still handle the invoice collection. In-house, it's a bit like a short-term loan against the value of an invoice. Invoice factoring is where you effectively sell the unpaid invoices to a third party called a factor, and they pay you a percentage of your invoice value up front, then they collect the payments from your customers. And there are two main types. Recourse factoring is the most common. Here, you would agree to pay back any invoices that they don't recover. So if the factoring company isn't paid, you reimburse the funds that they paid you. With non-recourse, the factoring company takes on the risk, and as a result it costs more per invoice. Generally speaking, invoice discounting is more affordable because the finance provider does less, but it tends only to be offered to larger, more established companies with robust internal credit control. Factoring is more common for small businesses or startups. Whichever option you choose though, make sure that it's a reputable FCA regulated provider and make sure you understand all the fees. So you have discount or interest charges, which are basically the cost of borrowing, a percentage rate applied to the funds drawn down, calculated usually on daily or monthly basis. Management fees or commissions, which is an ongoing service fee for running the factoring facility. It could be a monthly fee or a percentage of the value of the invoices factored. You can have credit protection, which is an optional extra for the factor to absorb the risk if your customer doesn't pay. If you don't take it, you're automatically on a recourse basis, meaning you carry all the risk. Transaction costs, so small charges for each drawdown payment or transfer made to your bank account to cover those charges. So let's take a simple example of a £50,000 invoice on a factoring basis. Advance rate of 85%, so you get £42,500 in advance. The customer pays in 60 days, and the discount or interest charge is 6%, so you pay £420. And this adds up if the payment is late. Management fee of 1% of the invoice value, so you pay £500. You have credit protection at 0.5%, so you pay £250. There's a transaction value of £30 per transfer. When your customer pays in full, the factor releases the balance. So you end up with £6,300 being paid and a total therefore of £48,800. So your effective cost of factoring was £1,200 or 2.4% for that 60-day period. If you compare this to invoice discounting, again, you get the same advance of 85%, so £42,500. It's the same cost of the interest at 6%, so £420. The management fee is 0.2% of the invoice value, so you pay £100 on that. Transaction stays at £30 per transaction. So you pay a total of £550 or 1.1%, and you receive a net £49,450. So it's cheaper. Alternatively, and I think this is a much better option than either factoring or discounting, you can try and copy the effect of it by offering your clients a discount for early payment. You retain control, it costs you less, and it can also build relationships with your customers. I hope you found this useful. If you did, hit subscribe, drop a comment, or get in touch at focus15.co.uk. In the meantime, stay focused and see you in the next one.